when students send me the assignment, I look through it more from a point of view of presentation and does it make sense and does it look right. I'm not going to look at the detailed calcs because I just don't have time to sit and check everybody's assignment in detail like that. I assume that the calcs are the ones we did in class, because if you've come up with your own calcs, then you must let me know. Or you must ask that specific question, not just, oh, have a look. Okay, so let me put away this book. So today we're starting what's going to take us 3 weeks to work through, which is changes in ownership. Put this away here. To make copies for Tyler when he comes. He's not here today. Okay, increases in ownership is what we're dealing with today. Piecemeal acquisitions. Okay, so today we're dealing with changes in ownership, and we are dealing with increases in ownership. So we're going to deal today just with increases in ownership. So far, when we've looked at groups, we have looked so far only at where we go from 0 to a sub or 0 to an associate, isn't it? We haven't looked at anything beyond that. When we look at changes in ownership, we in essence are looking at two new things. We're looking at number one, where I have a subsidiary and it becomes a bigger subsidiary, or where I have an associate, I had significant influence and it now becomes a subsidiary. I now acquire enough shares to gain control. Yeah. So if I'm looking at percentages, I maybe had 60 and I bought 20 and I now have 80. And with an associate, maybe I had 20 and I bought 50 and I now have 70, for example. Yeah. So those are the two scenarios that we're going to look at today, the acquisition of a subsidiary. The principle or the calculation that you're going to do is a calculation that doesn't look very different to the calculations we've looked at before. So, Calc for increase in investment. It looks like this. Fair value of assets and liabilities. That's what we've always done when we have an acquisition, isn't it? We look at the fair value of assets and liabilities. And we do that whether we're acquiring control, whether we're acquiring significant influence, whether we're acquiring joint control. We look at the fair value of assets and liabilities. We take equity as the representation of assets minus liabilities, and then we make adjustments, isn't it? So we start with fair value of assets and liabilities. We then remove NCI. So then we say, hang on, I've got fair value of assets and liabilities. It's not all mine. So I remove NCI. And remember, when we remove NCI, we have two options: percentage NAV or fair value, depending on what they tell you in the question, yes? Full goodwill, partial goodwill, or proportionate goodwill. So either we just take that fair value over there and take their percentage off, or we take the fair value based on the share price. They give you a share price in the question. Then we're left with fair value attributable to the company, to the parent. Let's say parent. Now, we're dealing with increases in investment. And so therefore, this is where the first rule now will come in. When we're dealing with increases in investments, we have to look at the fact that we already own some shares, isn't it? So when I say that's the total fair value, let's say it's 100. Well, it is 100. Let's say the NCI owns 20, so we own 80. We didn't buy the full 80 this time round, isn't it? We already had some, so we're just buying the rest. So what I then do is I take off the fair value of the pre-existing ownership investment. The fair value of the pre-existing investment, I take that off. What this necessarily means is that because I take off the fair value, there'll be a remeasurement, isn't it? There will be a remeasurement of that fair value of the investment. Either it was an investment in a subsidiary, in which case there may not be a remeasurement, or it was an investment in an associate, in which case there would be a remeasurement, isn't it? From associate equity accounting, because do you agree that's what I would have been doing, to fair value. From associate equity accounting to fair value, there would be a remeasurement. And that remeasurement would go into my P&L. This remeasurement lands up in P&L. Let's do a little thing here. So I used to have an equity accounted investment. I was carrying it at equity accounting. The statement now says I must measure it at fair value. So there will be a remeasurement of that investment, which will land up in my P&L. Okay, so if I go back to my calc, fair value of assets and liabilities less NCI is what's attributable to the parent. Less what the parent already had from before leaves us with the fair value acquired, with what I'm buying now. And let's assume that these percentages were, I don't know, 30. So therefore I'm buying 50. Yeah. Then the difference between what I acquired now and the consideration paid gives me goodwill or bargain, depending which way it goes. Do you agree? Goodwill or bargain. Goodwill if I paid more, bargain if I paid less. So let's look at our calc. Fair value of assets and liabilities of the company at the change date. Then NCI. Then the fair value attributable to the parent. The fair value of what I had before gives me the fair value of what I bought. Compared to what I paid gives me goodwill. Yeah? So that's the transaction. Do you agree? This is IFRS 3. This is IFRS 3, my IFRS 3 transaction. So this over here is IFRS 3. It's acquisition of control or not. I'm going to talk to you about what happens if there is no control acquired. That's the first step. You will always do that calc, isn't it? The second step is to do with my timeline. Now, if you recall my timeline, I kept track of 3 time periods, isn't it? I kept track of acquisition, beginning of year and end of year. When I have changes in ownership, it requires me to keep track of an extra piece. Because if I had a second AC here, and if I use the same numbers that I had in my example, then I acquired 30% here. From here to here, I own 30%. In the current year, from here to here, I own 30%. Then I acquired another 50. So then from here to here, I have 80%, and I have a sub at your end. Isn't it? So whereas before I had 3 time periods, I only worried about 3 times and 2 time periods, isn't it? I worried about acquisition, beginning, and end. Yeah. So that was before, acquisition, beginning, and end. And I worried about the movements between those 3. I now will have to worry about an additional time period, which is second acquisition. And then I need to worry about the percentages, because when I look at, say, retained income, then from acquisition to beginning of year, then my share is 30. From beginning to second, my share is 30. From second to end, my share is 80, isn't it? So even if I'm just looking at percentages, I must make sure that those are correct. But then in addition to that, I also must check and make sure that I get it right in terms of what I'm accounting for, because for this specific example, for this time period up to there, I have an associate. And so therefore, for the current year, I have share of profit of associate. Do you agree? For the rest of the year, I have a subsidiary, and therefore I consolidate. And you remember from second year when we had acquisitions of subsidiary in the middle of the year, and I was only consolidating for a certain number of months. I will have the same thing happening here. Although I had the investment the whole year, I'm only going to consolidate a certain number of months, because the other number of months it's going to be associate accounting. Yeah? Okay, so that's the second piece of changes in ownership. So just like consolidations, we worried about 2 bits. We worried about the transaction of acquisition and what it meant and how we calculated consideration and goodwill and fair value of assets and liabilities. And then we worried about the actual consolidation since acquisition. Here it's the same thing. At acquisition, I must make sure I do this calc. It doesn't look different to the calc we've done before, except for the red bit, isn't it? The fair value of our existing ownership. And then when I do my timeline, again, it looks the same as what I had before, except now I have an extra time period, which is the second acquisition, and I must make sure I split it correctly. And then I could have a combination of associate and subsidiary, or subsidiary and associate. Let me tell you about the third thing, which is an important one. When I have a subsidiary, that stays a subsidiary. So in other words, a change in ownership, but no change in control. Do you agree that that's what I have? Change in ownership, no change in control. When I have this, a subsidiary to a subsidiary, which is a change in ownership, but with no change in control, then the statement says that it's a transaction between owners. And so therefore, this transaction between owners of the business belongs in statement of changes in equity. And so therefore, the second thing I'm supposed to consider here is that is that I already had control. Because do you agree that if I earned 70 and now I earn 90, I already had control? So therefore, there's no goodwill in this transaction. It's a transaction between owners. It happens in statement of changes in equity. And I already had control, so there's no goodwill. There's no goodwill. And so what I will have, because I will do that same calc, is I'll just have a number going into statement of changes in equity. All right, so we're going to work through one of these first, because this one's easier. Do you agree if I have this one, and if I draw a timeline for you? Let me draw a timeline. Yeah, let me draw it here, because then it's all on the same page. If I draw a timeline for you of this one, there's end of year, there's second AC, there's beginning, there's first AC. And let's assume for this one, I had 70, and really the number, I must write slower, I think. I had 70, and then I acquired another 20. Do you agree that when I have a sub, that stays a sub? It's a sub the whole time. Do you agree? Do I consolidate 100%? Yes, because that's what I always do with a sub, isn't it? I don't bring in 70% and then 20. Not when I consolidate, isn't it? So if I look at what this means, if I have a sub that stays a sub, what it means is that when I'm looking at retained earnings, if I'm looking at retained earnings here, for this period up to beginning of the year, I'll have 70% of retained earnings. And that in the current year, let's just look at retained earnings and other reserves. When I look at NCI is going to have, at this stage, 30% of the retained earnings, isn't it? So my retained earnings are 70, NCI is 30. In the current year, this is current year, I'm going to consolidate the entire year, isn't it? Let me not do it like that. But in the current year, let me put the blue. I'll put these things back in the wrong place then. NCI's share of profits for the first period is 30%. NCI's share of profits for the second period is only 10%. Isn't it? And so I just need to keep track of the dates for that reason, isn't it? So what you'll do is you'll have to apportion the year. But you're anyway going to apportion the year, because remember I said to you, we need to determine at second AC, I need to determine fair value of assets and liabilities. How do I determine fair value of assets and liabilities halfway through a year? I have to apportion profit, isn't it? So I anyway will have apportioned profit when I do it here. So the profit by the time I get here to this timeline or the next timeline is already apportioned, isn't it? But yes, for this one, it's not so important to apportion it because it's all going into my P&L. Because my P&L, I had control, I still have control. It all goes in. The apportionment now is only going to come into effect when I'm doing the NCI's share, because it will be 30% from beginning up to the date of change, and then it will be 10% from change till year end. All right, so we're going to work through two examples. We're going to look first at an example with example 6.1, an increase in an existing subsidiary. No change in status with a reval. Okay, but revals we're used to seeing already from second year, isn't it? So with a reval. It's on page 169. 169. So our year end, first of all, is December 03. So if I started off at the top here with a little timeline, I have December 03 at the end here, which is year end. I have December 02 somewhere here, which is the beginning of year. And then if I look at the story, I'll be able to pick up the rest. So it says 1 Jan 01, we acquired 60%. So 1 Jan 01 is over here, and I bought 60% at that date. So that's my timeline so far. 1 January 1, I acquired 60% of Aqua and I paid 190. Share capital has remained unchanged. The only reserve was 75,000 Rand, and which was retained earnings. There were no assets, liabilities, contingent liabilities. Fair value of all assets and liabilities was the same as carrying amounts, except for land that had been revalued at 60 more than cost for the purposes of this acquisition. Alpha did not process any reval in their records. So if I do a quick calc over here, what is the share capital of Alpha? 200. Acquisition 1, share capital 200, retained earnings 75, reval of land 60, CGT, presume I must do CGT. Let's see what we must use for CGT. Always check what you must use for CGT. I just want to warn you, pre-warn you. I've seen questions where they ask you to use 18.6 as the CGT rate, which is 28 times 66.6 rounded. Yeah. So if they say to you to use 18.6 and you don't, then your numbers are going to be unrounded and they're going to then not match their numbers, isn't it? But we're going to take theirs. So what is it? 60% times 28 times 66.6. 11,189. Of course, why would it be a straight number? 11,189. And that's a minus, right? Because tax is always the other way. So if I add that all up, oh, 81. But there's a 9. 811. Oh, okay. 323,811. Okay. 323,811. All right. Now I have to take out NCI. NCI is 40%, right? Because they said we bought 60. I must check to see if NCI is at fair value or at percentage NAV or what it is. So I again go here. And they say they use the partial Goodwill method, okay, which means that, and they tested Goodwill and found it not to be impaired. Okay, so partial Goodwill method over here, then 40% of that belongs to NCI. So have you got a number for me? 129. Yeah. 524 is NCI, which means that my share is 286. I paid 190, they told me. So 4286 is a bargain. That bargain was long ago. Let's look at our timeline. Look how long ago it was. Long ago, isn't it? So that bargain is going to land up in retained earnings. I must remember to put it in retained earnings, or I must immediately go put it in retained earnings, depending, what they asked me to do. Probably you'll find that this required is just to do all the statements, prepare all the statements. But in the exam, you would never get a question with all the statements. You would get 1 or 2 of them, but not all of them. But this is just all the statements. All the statements, okay. So that's first acquisition. Let's just check our numbers. There should be an analysis somewhere here. They like to do analysis. Here we go. That's what we got, a bargain for 287. Did we get 7 or 6? Doesn't matter. I think we got 6, huh? Doesn't matter. There it is. And that's the beginning, right? Okay, let's carry on then. This part so far is what we already knew how to do last year. Then it says, on the 30th of June 2002, Aqua sold a piece of land. Aqua sold the land for 110, right? So this is that on acquisition thing that we had over here. We had a reval with a CGT, And it was land, so there would have been no depreciation or anything like that, isn't it? So when they sold the land, 30 June, they sold the land. That was beginning of year. Do you agree? Beginning of year. I therefore must adjust retained earnings for 60 and 11,189. And I've got to adjust retained earnings that way. Do you agree? Because look, we said the land was worth more. So when it was sold, from a group perspective, the profit would be less. I must reduce retained earnings, isn't it? So now I've found two adjustments that have to go to retained earnings. I've got this one, and I've got that one over there, the bargain. So when I do my statement of changes in equity, retained earnings, beginning of year, I must remember to put in the bargain, and I must remember to put this in. But remember, I'm saying I must remember, when you do it, you're going to do it backwards, eh? So you're going to immediately go to that retained earnings and put it in. Otherwise, if you keep putting in your mind, oh, I mustn't forget that, you're going to forget. Yeah? Okay, so those two numbers must go into my retained earnings. The land that was sold, I had adjusted the value of land at acquisition, but now the land's not there anymore. It must come in on AC to make my on AC journal balance, but then it must go out again to retained earnings. Sometimes you see that done in one entry. So they take it straight to retained earnings here. Yeah, debit to retained earnings instead of a debit to land. But I prefer to see a debit to land there and then a credit to land and a debit to retained earnings there. Okay. Okay, then on the 1st of October 3, 1st of October 3 is in the current year. Do you agree? It's when in the current year? 9 months, because our year end is December. Okay, so I want to work with that. I want to make sure that I understand that months, although only applicable if they say to you that profit is earned evenly. Hey, if they give us information about profit, then that's what we must use. So 9 months into the current year, we acquired an additional 6,000 shares. Let's go see how much 6,000 shares is. They have 40. So 6 over 40 is what? Doesn't even sound like a round percentage. 15? Okay. So this is 15%. So we went from owning 60 to buying another 15 here, 1 October, is it? Yeah. Plus 15. So we now own 75. Okay. So let's see what they say. On this date, there was no change in fair value of all liabilities. The profit of Aqua, other than the effect of the intergroup transaction, was earned evenly throughout the year. Oh, no, but there's an intergroup transaction. Equity investments are measured at fair value through P&L. The cost is considered to be the fair value. So yeah, they've given us that fair value story, isn't it? But if we go back to the trial balance, we don't see a mark-to-market. Do you see a mark-to-market? No mark-to-market. Hey? The only thing we see is retained earnings. So they've told us this, but they also said the cost is the fair value. So actually, I can just ignore this, isn't it? They needed to tell me just so that I know, but I can ignore it. There's no adjustment that needs to be made. Okay. So I need to look at this intercompany transaction number 5 because they say that profit is even except for this transaction number 5, right? So I have to look at this transaction number 5. So it says on the 2nd of October, they sold machinery with a carrying amount of 80. Aqua sold machinery to Bon. So here's Bon, here's Aqua. The profit went this way. Yeah? With a carrying amount of 80, and the profit is 40. Do you agree? Profit is 40. Depreciation is over 5 years. So over 5 years, this profit will come in at 8 per annum. Just make sure that's legible. Divided by 5 equals 8. But then the transaction only happened in the current year from October, November, December, 3 months. Times 3 over 12 is going to give me a funny number, I just know it. Oh, it's 2. It's a quarter, of course. It's a quarter, so it's not a funny number. All right, but we're trying to split the profit. So that 40,000 is sitting in Aqua's books as income. But it happens after, it didn't happen before, so I have to remove it before I apportion. Do you agree? So let's go try and apportion that profit. So here's the trial balance. Okay, here's the profit before tax, 240. And here's the tax. Is it that? 67,200. Okay, so what is the profit after tax? Okay, so remove the profit on the machine. Is it machine? It's 40 times 72%. Straight. How much am I removing? 28.8. Okay. So the profit in Alpha is 172,800 after tax. Included in there is a profit on sale of a machine, which after tax is 28.8. That profit on the sale of that machine is in the second 9 months period, isn't it? So in the first 9 months period, so now if I split this profit into the 9 months and the other 9 months, so the first 9 and the second 9, I get, if I take 9 months, what do I get? 3/4. 108. Okay. And then the other piece would be the 32, is it? But then I've got to add the 28.8 to that. 36. See, I can't add to save my life. 36. Yeah, it's the other way around. And I've got to add the 28.8. Do you agree? 36 plus 28.8 is 64.8. Oh. No? Yeah? Yeah. And look, this is what needs to balance. This 108 plus this 64.8 needs to tie up to that total profit, hey? And it does. Okay. So, so we've got our split of the profit, okay? So we can do our second acquisition. All right, let's do it at the bottom here, since there's no space anywhere else. Second acquisition. Share capital was still 200, is that right? Was it 200? 200. Retained earnings at beginning, 150. I'm going to take it off the trial balance. Yes? And then profit of 108. Then I must adjust for that land, because the profit of the subsidiary is being overstated. Do you agree? By that land adjustment. The 30, what was the number for that land? The 20, no, it was this one. What is it, 40 something? 48, 8111 or something. 811. No, I don't know if I must adjust it. That land's gone. Because there I made it bigger. Now it's sitting in retained earnings. No. The land is gone, right? I think it must just be like that. Let me see what they do here. 10 to 100, let's see if we get that or not. Okay, what does that add up to? 458. And we bought 15%. We can put NCI in. The new NCI is 15. Is that right? 25. Sorry, 25. So this is 100%. NCI is 25, which is 0.5. Okay, giving us 343.1. 0.5, yeah. And then we already owned from before, isn't it? And this is assets minus liabilities, isn't it? So fair value of what we owned before. We owned 60. Was how much? 60 of 458. Okay, which gives me the fair value acquired, which is the 15. 68.7. Okay. We've got to go see what I paid. They didn't say there, isn't it? They just said on this date, there was no change other than that. And they didn't say how much I paid, so I have to look up here. Investments in Aqua. Here's what I'm paying, the total investment, less the 190, yes. So it's made up of a split, isn't it? Of 190 and 78.9, is it? Okay, so I go back down here. I paid 78.9, so therefore there is a 10.2, which would have been Goodwill. But it's not Goodwill, right? Because there's no Goodwill. Not Goodwill. So it's therefore, it needs to be a debit still, isn't it? Because that's what Goodwill would have been, a debit to make it balance. So it's a debit, but it's a debit that's going to go in statement of changes in equity. Remember I said to you, it goes in statement of changes in equity, that debit. Yeah. Okay. So that's that transaction. We've done that piece there. There's nothing there. Let's do the timeline. You happy to do that? Do a timeline. So acquisition, first acquisition, 1 Jan 01. There was retained earnings. And there was a reval, isn't it, that we created. It was 48,811, the reval. The retained earnings was 75. Then, beginning of year, retained earnings had become 150. And the reval was gone. Yeah? The reval was gone at that stage. And then our two bounces in the current year are a 108 and a 64.8. Okay. This bounce is a 75. £75. This minus 48,811, we're going to remove it off retained earnings, isn't it? Because remember, we said it's an adjustment to retained earnings. Do you agree? Because it's profit that's sitting in retained earnings that shouldn't be there because it was sold somewhere June, of 02. So what's this net number? Okay, let's look at NCI percentages. So beginning, acquisition 1 to beginning, NCI is 40. Do you agree? 40% NCI. Then the first piece of the year, NCI is 40. The second piece of the year, NCI is 25. Are there any dividends in the question?
Yeah.
How much?
30,000.
30,000 paid at the end of the year.
Yeah.
So NCI is 25% of that. Let's work out all the NCI pieces, then we can go and see if our numbers flow through. I also here want to just put in the 60 because that's going to go into retained earnings. $26,189, 40%, 10,476, 15,713, 108, 43.2, 16.2, 7.5. Agree? All I did was the percentages. All right, let's go and have a look at the financial statements. So I start off with our financial position. We don't see any adjustment to any goodwill. Yeah? And in fact, the only adjustment that we do see is the adjustment to the machine, intercompany sale of machine, reduce machine, bring in 2. That's the calculation we had, do you agree? And the tax on those numbers, the tax. Okay. They ended up with a deferred tax asset because there was no deferred tax, it was just on the numbers. So if I am crediting PPE, I'm going to debit deferred tax. And that's how come I landed up with a deferred tax asset. Everything else looks like it's just straightforward add. Okay? These numbers here, retained earnings and NCI, we're going to get from changes in equity. What you'll see is there's another component of equity here, which I'm also going to show you on the statement of changes in equity. It's that transaction, that IFRS 3, that goodwill that didn't exist, isn't it? Okay, but here's the P&L. In the P&L, what we see, the adjustments that we see in the P&L are again for the machine and for the 2. And then we also see the intercompany dividend being reversed. Yeah, our share, 75% of the intercompany dividend being reversed. And then you see the machine and the 2 tax adjustments. So it was pretty straightforward. NCI, they've got 52,560. Let's go see what we had. We didn't have that. Oh, we forgot to put in the intercompany. Where's the intercompany? Over here, isn't it? The machine. The after-tax machine was 28.8.
Yeah.
Plus the 2 million after tax. 144. Do you agree? So the profit, I have to remove that machine, and I have to bring in the since, the 2. That's intercompany adjustments, isn't it? 37.44, 25%, 9.36. If I take those two together, 52,560. Oh, we did all the calcs and then we forgot to come put it in. And when I did it, I even showed it that it was upstream, isn't it? Okay, so this is the 40 after tax. That's the 2 after tax. The 40 and the 2 we had worked out. Okay, so 52.56 is the NCI over there. Okay, here's the statement of changes in equity with the new column that we haven't seen before, that we're seeing for the first time. Change in ownership. So there'll be a column called change in ownership relating to the purchase of the additional interest. It will either be a debit if you then paid more than what you got, or it will be a credit if you paid less than what you got. If you pay more than what you got, it's considered to be a loss. If you paid less, it's considered to be a gain. But you don't need to say gain or loss. You just say purchase additional interest, change in ownership. It lands up as being another column in your statement of changes in equity. Yeah, 10,200. Then retained earnings at beginning of year. If we look at the numbers, parent plus sub. Where's the sub? It was 150 at beginning, that one, right? Parent plus sub. Then we take out on AC. And then I put in the bargain, and I take out the 48. Right? Because that's what I said I needed to do. Do you remember me saying, remember, we've got to go do that? Okay, I take out the bargain and I put in the 48. Then I bring in the parent's share of profit. So if we look at our P&L, no, we don't. We're still working at beginning, hey? Where am I now? No, I'm down here. Okay, then I've got to bring in NCI's share. What was NCI? Was it that? 15713. What do they have? 15713. Where is it? NCI's share. No, but why are they adding it? We would have subtracted it, right? We would have subtracted it. It's not a loss, is it? It's a gain. Okay, let me not do that. Okay, let's just see what we would have had. We would have had the 500 and the 150. We would have taken off the 75, taken off the 48,811. I'm reducing the profit on the sale of that land. Added the bargain. And removed the 15,713, which belongs to NCI. Is that right? Do you agree? What does that add up to?
But isn't the NCI the 40%? 40% is the 10,476.
My share is the...
Our share is the 15,713. NCI is that.
Okay. So this is the NCI piece there. Okay. Or the other way around, which is 500 plus the 4 less the 15. Yeah, we probably would have done... Yeah, I probably would have done it like that. Yeah. Parent plus sub. Parent plus sub on AC. Bargain. Adjustment. NCI. Yeah? And that would have given me my balance. Parent plus sub plus bargain less on AC, less adjustment. Because that's the way our journals would have worked, isn't it? Okay. So that's how I would have done it. those all the way that they've shown, like the or always just confused me. Wanted to be able to show that a bit better. Yeah, parent, sub, on AC, bargain, since adjustment for the land, NCI's share gives me that 520, this number. Then profit for the year comes off my P&L, dividends paid comes off the balance sheet. NCI, let's go see what NCI is. NCI, my NCI, at beginning of year would be the on AC, the first acquisition, went 129. So this number here, they don't have a calc, it must be somewhere. 129,524 plus their share of the since profit. Does it work out to 140? The 10,476. So on AC, since gives you the 140. Okay, then you purchased from them. So profit for the year, those are fine, those are carried forward. You purchased from them 15%, isn't it, of the net asset value? So 15% of the net asset value, if we go back and look at our calc, fair value of 15% was 68,700. Is the 15% that I acquired. Who did I acquire it from? NCI. So when I look at that line, you'll see that that line adds up to, sorry, next page. There's the 68,700. It adds up to the amount that I paid. Yeah, so I paid 78,900. Equity dropped by 78. Assets and liabilities of the group dropped because NCI got 68. I bought from NCI 68,700, and 10.2 is what I paid extra. Yeah, all debits. Yeah, so the change in ownership is a debit. It would have been Goodwill. The NCI drops because they dropped from 40 to 25, and then the total equity is the total. So that's your new line and your new column that you see in statements of changes in equity. Then the dividend paid is the 7.5, which we had worked out. They normally do not ask journal entries for changes in ownership. Yeah, they ask journal entries for AC, since, NCI's share, intercompany transactions, normally joint ventures they like, normally not for changes in ownership. I've never seen. But the journal entries are here. We can have a look at them. There's the analysis. What you can see with the analysis is that the analysis then takes on a new funny thing because there's an acquisition, isn't it? So they do on AC, and then they do since, and then they do a piece of the current year. Then they break the current year to do the acquisition. So they do like a little acquisition calc in the middle here, and then they carry on. But you're not doing, the analysis just gets bigger and bigger, isn't it, as you have more things. But we're not doing those, luckily. So here's a calculation of the split of the profit, which we did fairly easily. I don't think it needed. Here's the pro forma entries. So they started off with a reval, and then they did the reval surplus. I like to do this entry in one, so I don't have that contras that. Basically, you can see debit, credit, and I put that in there. That's the way that I like to do it. But it's fine. There's your first acquisition entry giving you a bargain. Then we have the adjustment for that property. And we have the since acquisition NCI's share of retained earnings. Normal entries, nothing unusual so far. Then we have their share of the profit for the first 9 months, just to have it chronological. And here's the change in ownership journal. It's a very simple change in ownership journal. NCI drops by 68,700. I have a change in ownership, a loss of 10,200, which goes to statement of changes in equity, does not land up in Goodwill, does not land up in P&L. And then I've got to credit the investment with the 78,900. Because remember, the investment is sitting at 260 something, isn't it, on the trial balance? And my first acquisition journal only got rid of 190 of that investment. Yeah, this acquisition journal here, look, it only got rid of 190. So the other 78 is still sitting there. If I don't do another journal to get rid of that piece, it won't disappear, isn't it? So here's the journal to get rid of that piece. It's a very simple journal, do you agree? I'm just making NCI smaller, making my investment, getting rid of the rest of my investment, and then the difference is my balancing figure, which goes to statement of changes in equity. And then the rest of the journals are straightforward. The other 3 months of profit going to NCI and the dividend elimination. Yeah. So that was a pretty straightforward one. In type letter 103 is this question. Anybody got those type letters? You've got nothing more. Okay. I'll go make a copy for you of that type letter. Type letter 103, 102, I think it is 102. Let me just double check. Type letter 102. Type letter 102 is extra questions, isn't it? You know, if you don't have them, you should really just make a copy and start to practice, because now your assignments are done. So initially, when you're still trying to do assignments, although I'm not sure, we say assignments are done, they're done for this module, but for other modules, you might still be busy. But they're getting done, isn't it? So it's time to start working through questions. Type letter 102 has a whole lot of questions. This is one of the questions in type letter 102. I'm going to go make a copy for you, but in the meantime, you can start to look at the question. Let's see if, can you read that? No, sort of. But you know what I can do? Oh, I was going to say I can split it, but I don't think I can even do that. But I can do this. Okay. Yeah. Quiet. Okay. No, I can leave it up to there. There's nothing else that's funny here in this question, right? The reason I want you to practice it is, and you're going to follow the same principles that we just followed, right? You're going to do, if I just go back, this question is one of these. One of these, where I have an associate that becomes a subsidiary. So your calculation is going to look like that initially, your first one. You're going to have two of these. You're going to have the one for the associate, but the associate doesn't have NCI, isn't it? I just need to work out if I had a bargain or not, because it affects retained earnings. Yeah? And then I'm going to do the actual acquisition entry when I have a subsidiary. Then, so you're going to do this for me, and then you're going to do this for me. It's an associate up to a point, and then the rest of the time it's a subsidiary. Be careful. What did I want to say? Yeah. Let's just leave it like that for now. So I want you to do all the workings, and then we'll have a look and see how our numbers flow through. Once again, these questions ask you to do the entire statements. It's not an indication of what the question will look like in the exam eventually, because in the exam, the question will... in the exam, the question won't be do all the statements. It'll be do a piece of it, isn't it? They say do a P&L and a statement of changes in equity is what they're asking for. Yeah, there is some other stuff there with Goodwill. Okay, but I'm going to leave this part on for now. Let me see if I can get it just to there. $50,000 shares. Okay, just to there. On the 1st of January, 11 our year end is June 14. You can see here the dividends were paid. June 14, that's our year end, okay? On 1 January 11, Lex acquired 10,000 shares for 40,000 Rand. The retained earnings were whatever, and they exercised significant influence at that date. So you're going to do an associate, and you're going to do associate accounting right up to this date, the 1st of October 13. They acquired another 16,000 shares. They have 50,000 shares altogether, you can see right at the top. And they acquired control. Okay, that's the first time there's an NCI. Yeah? So when you do statement of changes in equity, there is no NCI at beginning. It was an associate then. The NCI arose during the year with the acquisition. 60% of the gross profit was earned in the first 6 months and 40% in the last 6 months. So they obviously have a gross profit here. Oh, there it is. So here's the P&L items. I hate these questions because you have to go and look for P&L items, but you're used to them from second year, isn't it? So there's a P&L item, and there's tax. It looks like that's more or less all, isn't it? There's some dividends received, but there's a date on the dividends received. So that's after. What else is there? That's it. There's dividends paid, but that's not P&L. The rest is balance sheet. Do you agree? There's a reval. There's a reval over here. But just have a look to see when that reval arose. Yeah, that reval must have arisen after acquisition. I think the reval's on the next page. No, nothing about reval, huh? Maybe it was on the previous page. Let me see. Further down. Oh, here. The reval arose 1 July 12. Before. Yeah? Before. Okay. I'm going to leave it like that, and I'm going to go make copies for you of the question. Title letter 102, it was question 17. Come on, behave.